Welcome to the Real Estate Espresso podcast, your morning shot of what's new in the world of real estate investing. I'm your host, Victor Menashe. Each year, the World Economic Forum convenes in Davos, Switzerland. There's political leaders, central bankers, corporate executives, institutional investors, professors, journalists, and they're all taking the pulse of the global economy. The headlines that come out of Davos often feel abstract, even theatrical. Buried beneath the sound bites are themes that matter deeply to real estate investors, especially those who think like capital allocators rather than speculators. This year's forum is dominated by a somber tone. Gone is the optimism of a rapid post-pandemic recovery. In its place is a recognition the world is settling into a period of structural change rather than cyclical volatility. That distinction matters because structural change reshapes how capital flows, how risk is priced, and where real assets fit in a portfolio. One of the clearest themes is the end of cheap money as a default assumption. Policymakers are careful not to declare victory over inflation, even as headline numbers have moderated. The message is consistent. Interest rates might come down from recent peaks, but they're unlikely to return to the ultra-low environment from the 2010s. For real estate investors, this marks a permanent shift in underwriting philosophy. Projects that only work under aggressive leverage with optimistic cap rates are no longer viable. Capital efficiency and durable cash flow are back at the center of the conversation. Another dominant theme is geopolitical fragmentation. Supply chains are being reconfigured around resilience rather than purely efficiency. Words like reshoring, friendshoring, onshoring, nearshoring, and redundancy come up repeatedly. This has direct implications for industrial real estate, for logistics hubs and secondary markets that sit along new trade corridors. At the same time, it reinforces the importance of political stability at the local and national level. Capital is increasingly selective and it flows towards jurisdictions with predictable rules, enforceable contracts, and functioning infrastructure. Technology, specifically artificial intelligence, is taking center stage not as a novelty but as an accelerant. The consensus is that AI is no longer a future trend, it's a present force reshaping labor markets, reshaping productivity and space utilization. For real estate investors, that cuts both ways. On the one hand, efficiency gains might reduce demand for certain types of office space, but on the other hand, data centers, specialized industrial facilities, and infrastructure tied to digital networks continue to grow in importance. The mistake would be to extrapolate simplistically. Technology doesn't eliminate real estate, it redistributes demand across asset classes and geographies. Climate and energy transitions remain central themes, but with a much more pragmatic tone than in prior years. The conversation has shifted from aspiration to implementation, and governments and institutions are grappling with the cost of decarbonization and the trade-offs involved. For real estate, that means energy efficiency, resilience, and operating cost volatility are no longer peripheral considerations. When you write a business case, for example, on the benefit of insulating your building a little bit better, that's based on an assumption of the cost of electricity. And if that number changes, then your time to break even changes as well. Buildings that can't adapt to rising insurance costs, to stricter energy standards, will face functional obsolescence regardless of location. Perhaps the most important and least discussed is the theme of social stability. Housing affordability, demographic shifts, and inequality are framed not just as social issues but economic risks. Leaders acknowledge that housing shortages and rising living costs can undermine workforce mobility and political stability. Now, for real estate investors, that reinforces a fundamental truth. Projects that solve real problems like workforce housing, attainable rentals, essential services are more likely to enjoy regulatory support and long-term demand. Luxury and trophy assets still have a place, but they sit on a narrower base of demand. So what does this mean in practical terms? First, real estate investors should abandon the idea that macro uncertainty could be ignored. At the same time, you've got to resist the temptation to freeze. The message from Davos is not that risk has increased, but it's changed shape. Inflation risk, interest rate risks, geopolitical risk, climate risk, these are all structural features of the landscape. The response is not to avoid investing, but to price in your risk properly and design projects that can withstand volatility. Second, market selection matters more than ever. Capital is concentrating in places with strong fundamentals, with population growth, and diversified economies. Secondary and tertiary markets with the right characteristics continue to attract attention, especially where entry costs are lower and competition is rational. That aligns with the developer mindset. Build where demand is durable, not where the sentiment is the hottest. And third, having a disciplined capital structure is critical. The era of financial engineering as a substitute for business fundamentals is over. Conservative leverage, realistic exit assumptions, and contingency planning are no longer optional. That's just the price of admission. And finally, alignment matters. Investors are increasingly sensitive to transparency, to governance, and to execution risk. That mirrors the broader themes from the World Economic Forum around trust and institutional credibility. Real estate sponsors who operate with clarity, communicate honestly, and protect investor capital first are going to find it easier to attract long-term partners. The World Economic Forum is not going to tell you where the next deal is. What it offers is a macro lens on the rules of the game and how they're evolving. For real estate investors willing to adapt, to think like allocators rather than gamblers, that environment still offers opportunity. As you think about that, have an awesome rest of your day. Go make some great things happen. We'll talk to you again tomorrow.